InvestSMART's separately managed account benefit number 7. It's not a pooled investment. Pooled investments like managed funds can disadvantage the long-term investor who is happy to ride out the volatility of the market. Managed fund investors' performance can be negatively impacted by herd mentality of people putting cash into and taking it out of the market at the wrong time. In a separately managed account, there is no herd, just you.
G'day everyone, my name's Michael Sneddon and I'm joined today by Michael Glennon from Glennon Capital. Michael, thanks for joining us.
Thank you.
Now, for everyone who's recently joined Eureka Report and InvestSMART, they wouldn't have seen our previous conversations. It's been about a year since we've spoken. Can you maybe give a bit of a brief overview about Glennon Capital? The stock code's GC1, it's a listed investment company. What do you focus on and how do you do what you do?
Okay. A lot of things to answer there, but so GC1's the listed investment company that we manage. It's a small and micro cap portfolio. So just concentrating on predominantly listed equities outside the top 100, but predominantly in that smaller end of the small and micro cap space. So a lot of companies that are out there that are listed, and most of them in that small micro cap space. So it's a very big universe, a lot of companies, a lot of under researched, and we spend a lot of time going through those companies, meeting with management, trying to pick investments that are obviously going to go up. That's the name of the game there. So how we do it, we've got a pretty rigid investment process. So we spend a lot of time meeting with management, looking at business models, looking at capital structures and looking at profitability and trying to find businesses that we think over the next 3 to 5 years will do well.
Right, now it's been about 18 months since GC1 listed. In those last 18 months, what have you learnt about running a listed investment company, and is there anything you do differently from the IPO stage through to now?
The IPO is a hectic stage, but look, what would we do differently? I guess, look, it's the second time around for me running a listed investment company. I ran one 15 years ago, so I think we have done a lot of things differently from the first time we've done it. We're very active in terms of marketing and really engaging with our clients. So I'm a large shareholder in GC1 and I treat all of the shareholders that are in GC1 really as business partners. So we do a video every week, communicating the things that we're doing in our investment process, some of the stocks we like, why we like those stocks. So communication is a really big part of what we try and do, and I think you really need to, if you take that view that your shareholders are business owners with you, you really need to communicate with the people that you're in business with. So, anyone can go along and subscribe to our newsletter, which goes out weekly, and look at YouTube and see the videos that we do. So communication's a big part. Would we do anything differently? Yeah, we're constantly reevaluating what we do and how we communicate and how we talk to people, and we engage with our shareholders to try and get feedback about what we should do.
How are investors' expectations different from, say, 15 years ago when you were in an LIC to today?
The market's a lot more sophisticated. There's a lot more LICs out there. There's a lot more choice. So I think, there seems to be the superannuation industry is a lot more advanced now. And over that 15 years, there's been a big shift towards self-managed super. And self-managed super in Australia receives the benefit of franking. So, that doesn't happen in the States. So there's a big push for shareholders of LICs to get fully franked dividends. Now that doesn't always align itself well to investing in small caps, because the aim of investing in small caps is to get capital appreciation, where you can invest in the top 100 and you might not get capital appreciation, but you will get fully franked income. So the challenge for us, I guess, has been trying to give a constant stream of dividends that are growing to our shareholders when we may not be paying tax because our investment's appreciating on a capital basis. And a lot of small companies are hungry for growth, so the underlying investments in the portfolio may not be paying fully franked dividends. But we've been very happy. We've been able to pay 2 dividends now. We've declared the stock's cum dividend at the moment. So you can buy the stock and get that extra dividend. But in that first 18 months of operation, we've been able to declare 3 dividends, which we're pretty happy about. And it's sort of a rare situation for listed companies early on the piece to be able to pay out fully franked dividends in a very short period of time.
Now let's talk about the portfolio. If you look back in the January update, the monthly update, you would have seen Retail Food Group as your biggest holding. Yep. Look forward a month further to the February update, it's no longer there. Is it still in the portfolio, and what was the decision like to take it from that number one holding position down, or if not out of the portfolio?
So the weighting's halved in the portfolio, and we're pretty lucky with the timing. We halved it. The shares have been sold off, as you've probably seen. And there's a couple of reasons why shares have been sold off. It was a good investment for us, but we decided to reduce the weight because we got very concerned coming into the pre-reporting season and the early part of reporting season about just general weakness in the retail sector. And so retail food group, is primarily food-based businesses, which could be quite defensive, but there was a shift in Aussie small caps from traditional. There's a lot of big cap investors that come into small caps because the last 3 years, as you know, has been very good for small caps. That money shifted out of small caps, and it happened right on that date, when Donald Trump was elected into the presidency in the United States. So from November last year, there's been a sell-off in small caps from big cap people reducing their weighting to small caps. And the higher quality businesses, a lot of those were affected as managers because they're liquid stocks. The big cap managers were able to get out. So that was one of those companies that we sold out because we were concerned about valuations in the business, but we were also concerned on a domestic level about consumer sentiment. And there was quite a few stocks that we saw in the retail space that have been sold off very heavily. So if you look at things like Retail Cube Group, which is the owner of Athlete's Foot, it's been sold off incredibly heavily over the last year. You've seen Godfrey's, which is another retailer, which has been sold off quite strongly. So there was a lot of Australian retailers who'd been affected by change in sentiment, and the shares have been sold off quite significantly. So we looked at that, and that was where we decided to reduce the weighting in that stock. And that was the right call to make. And then what you're really seeing in the Australian retail sector at the moment is the companies that are doing well in retail, things like Nick Scali, are doing very well. The guys that aren't doing, aren't as good operators, have been sold off very heavily. So there's a real divergence in the retail sector. We didn't want to take that risk, and that's where we reduced the weighting.
Now, taking retail food group spot is National Vet Care.
Yep.
NVL is the stock code there. Tell us, it sounds like a roll-up strategy. Tell us about what they're doing and why you're holding it.
Yeah, it's a great business. We've had it in the portfolio virtually since the company listed, since National Vet Care listed, and since we listed, which was about the same time. It was about August 2015. So it is a roll-up, so they're making acquisitions of suburban vet practices, so the ones that you see around your neighbourhood. Their largest competitor is Green Cross, but the beauty of the industry is that a company like Green Cross, who's the largest in the market, has only got 6% market share. So the biggest player's got 6%, there's a lot of room for acquisitions, there's not natural buyers, and there's a bit of an arbitrage between a company like National Vet Care going out and making an acquisition of a suburban vet practice. And there's not really a lot of other people that they can sell that business to. There's sort of 3 acquirers nationally in the market of vet businesses. So it's attractive in terms of there's a lot of supply of businesses. They do very smart things once they get the business. So the management of National Vet Care are ex-Green Cross, so they knew what they were doing. That de-risked the proposition for us. 18 months later, they've now delivered on everything and exceeded what they said they'd do 18 months ago. Things like little smart things they do in their businesses. They've got national supply arrangements so that all of the pet care products and food that's sold in the vet practices is at a higher margin because there's one purchasing agreement across the group. They do a lot of training for people within their group, which brings more people to the party in terms of looking at future acquisitions. They've got a wellness program, so you can sign your animal up to have its teeth checked and dental care every 6 months, plus general checkups. So they're getting people to engage more with the vet and increase the revenue to the vet practice. So it's a really good model. I think it gives good care to the clients of the veterinary practice, gets extra margin out of it, and I think they've got a long way to go. The market's nowhere near saturation.
There's a couple of other roll-up stories within your portfolio currently. What are the risks associated with a roll-up story?
The biggest risk is execution risk and the company paying too much money. So when you get a lot of acquisitions, and we saw it happen many years ago when ABC Childcare was out there, and there's a few large groups in that childcare space. They, and everyone's competing for the same acquisitions. And so what's most attractive to a group like a National Vet Care or a Green Cross is picking up a practice that's got 4 or 5 vets, the bigger groups, and that's where you start to see the price competition. So that then forces them to either not acquire and not grow, or to start to look for more marginal type businesses, and that's where you get the risk. It's on paying too much for the businesses and trying to grow too quickly.
Now, anything else in the portfolio that excites you right now? Something that you want to share with the members?
Oh, there's a lot that excites me, and I don't say that as a blanket sort of statement. So 6 months ago, we were struggling a little bit. Prior to Trump getting in, when the small cap market was very hot, we were struggling to find new ideas. Everything seemed overvalued, and you make your most money by being strategic about when you buy and waiting for times when good companies are sold off because there's noise in the market. So there's been a lot of good companies that have been sold off now. So I'm incredibly enthusiastic as we make our way through some of those companies to see where there's any value there. Good businesses that are up to 50% cheaper than what they were 3 or 4 months ago. So that's exciting. The other thing, I think there's a lot more quality in the very micro cap end of the market. There's a lot more capital raisings that have been coming to market. And there's a lot of garbage there, but there's also a lot of good businesses if you've got the time to filter through and look at those things. So yeah, I'm very enthusiastic on a sort of macro sense about finding good small caps at more attractive prices. I don't think the broader small cap market will do well, but I think for people picking stocks, it's a great time. You've got cheap stocks, you've had a bit of hurt out there. You get retail investors selling because some of their stocks have been sold off, and they get scared by the short-term price sort of falls in stocks and start selling, and that's a great time to be buying. So yeah, I'm pretty enthusiastic. And on an individual stock level, I guess we do still like that roll-up theme, and smaller micro cap companies lend themselves towards that, so the portfolio is skewed a little bit that way. We're still benefiting from that disruption theme in terms of technology and apps and websites. So we've got Zip Money, which is sort of a disruption model to traditional finance companies. That's a good position in the portfolio. I mean, I could talk all day about stuff because I like them all, what's there, but I am excited about what's there, especially on the micro cap end of the market, the disruption theme, the guys that are consolidating industries and doing that roll-up type strategy. And I think there's a couple of other sort of areas that we're looking at in that are sort of quite been overlooked a bit by the market. Things like the resources have run up quite heavily, resource stocks over the last couple of months. Resource prices have risen, but I think that's all priced in now, so I think there'll be a bit of short-term weakness there. I think the mining services companies are still a bit of upside in some of those guys. So yeah, I'm optimistic about a lot of stuff.
Now, let's talk about the actual LIC itself and the shareholders here. Your share price currently, as we talk, is sitting around 93, 92 cents ish.
Yeah, I think it's 94. But
94 is it?
I don't watch it on an intraday basis, but
but the NTA is significantly higher, closer to $1 there. Yep. So we're seeing a discount to the net tangible assets. Of course, it's only been relatively short term, but what's the long term strategy with that? Like, what are you aiming to do if that gap continues? What's the plan?
Oh, I think, look, longer term, I don't think it matters how good your performance is. You need to be able to communicate with clients. But for me, as a shareholder, I'm after capital appreciation, but I'm happy with the performance over the last 12 months. I mean, we had the option exercise back in August of last year, so that was a good deal for investors, because if you put $50,000 into the fund, you had 50,000 options, and then you got to exercise those just prior to a dividend being paid. So you had your money, half of your money sitting in the bank. So if we had a really bad year or the market had gone down, you didn't have to exercise your dividend. But we had I think $25 million in the fund at that point in time, and we generated enough return off that to be able to pay a dividend off the fully expanded capital base. So it gave investors that came in at the IPO a risk-free entry into the stock. They got paid a full year dividend of 3 cents, which was fully franked, even though their money hadn't been in there. So it was a good return for investors. Plus, we've increased the interim dividend, which we paid in a couple of weeks, by 33%. So yeah, I'm happy with the cash returns that are being made out of the portfolio. Longer term though, my goal, and I think it's most people's goal in there, is to get some capital appreciation out of that portfolio and really start to drive the NTA up, which I think will happen because there's no more, while the options, it gave people a free ability to be able to sort of put half of their money in at the IPO. It also meant that we had to work twice as hard on the money that was in there to be able to generate that return. So we don't have that going forward. So of the money that we generate, there's sufficient to pay dividends, but it should just all drive the NTA up now.
Excellent. Well, Michael, thanks for joining us and catching up on what's happening at GC1. And members, we'll catch you next time.